Hello and welcome to Money Not Math episode 158. I'm Drew Erickson, and today we are going to discuss Warren Buffett's recent comments on Berkshire Hathaway's cash holdings and what they mean for investors like you. In his latest annual letter to shareholders, Warren Buffett addressed concerns about Berkshire Hathaway's substantial cash reserves. As of the end of the fourth quarter, the company held $334 billion in cash. This has led to speculation among investors about why Berkshire is holding on to so much cash and whether there are no good investment opportunities available. This is also important to note that many people try to model their investing based on what Warren Buffett does. Keep in mind what he's doing and his capabilities are way different than what the individual retirement planner can do and maybe should be doing, right? I mean, we don't have $334 billion in cash available to go out and buy companies and own companies in many ways. What we mostly have to do is buy little shares of companies, and we certainly don't have that much cash involved. So even though we can learn a lot from Warren Buffett and what he does and what he believes and the principles he invests by, it does not mean you should always do exactly what he does. All right. So, with that being said, Buffett reassured investors by emphasizing his preference for owning good businesses over holding cash. He pointed out that despite the large cash position, the majority of Berkshire's money remains invested in equities or stocks. This aligns with his investment philosophy of being patient and waiting for the right opportunities rather than rushing into investments that do not meet his criteria. When it comes to your personal retirement planning, I liken this to building your strategy based on what makes sense for you rather than chasing the next hot investment that your friend or the news told you about, regardless of how it fits into your portfolio strategy. I see this often where people will just go buy Dogecoin or Bitcoin or Nvidia or whatever the name of it is. They just go buy it because that's what everyone else is doing and because it's been doing great, regardless of maybe how it fits in their strategy. Warren Buffett's sitting on $334 billion of cash. And even though he'd rather have that cash invested in equities, he just hasn't found the right opportunity yet. So make sure your plan is built on your strategy and your goals and the outcome you want, not just on what other people are doing. And just because something's hot right now, it doesn't mean it fits well in your portfolio. Another highlight from Buffett's letter was the performance of Berkshire's insurance arm, which played a significant role in the company's earnings gains last year. So keep this in mind. Berkshire Hathaway, though it's well known for its investment, it owns companies. It has an entire arm of its company that just does insurance. Can you afford to own an insurance company? Probably not, right? So again, it's important to build your strategy based on your personal goals and situation, not just based on what the big guys are doing. Operating earnings rose to $47.4 billion for Berkshire Hathaway, a 27% increase compared to the previous year. This was despite more than half of the company's operating businesses seeing a decline in earnings. So more than half of Berkshire Hathaway's companies had a decrease in earnings, and yet they still had a 27% increase compared to the previous year, largely due to its insurance segment, along with predictable gains from treasury bills, helped drive these impressive results. This is a strong reminder of the value of having your personal retirement investment portfolio well diversified so that even when some of your holdings see a decline, your overall portfolio still has the opportunity for growth. Buffett also expressed confidence in Berkshire's Japanese investments, suggesting that these holdings could increase in the coming years. This is an interesting move considering the diverse nature of these Japanese conglomerates, which are involved in everything from mining to healthcare. And this kind of just touches on why all of my clients, or I believe, have some percent of their portfolio invested in emerging markets. We aren't just stuck in the U.S. markets because just like Warren Buffett does, he's investing worldwide because even the Japanese market has a potential to be huge in the future. So that's why we like to diversify not only in the U.S. market but worldwide, so that whether it's Japan or other countries, whenever they maybe hit their hot streak, we can take advantage of that. So what does this mean for investors? Buffett's message is clear. Patience and discipline are key. Holding onto cash is not necessarily a bad thing if it means waiting for the right investment opportunities or because the cash aligns properly with your retirement strategy. And with Berkshire's strong performance, particularly in its insurance segment, it's evident that the company is well positioned for future growth while illustrating the importance of diversification within your investment portfolio. And I repeat, Patience and discipline are key. Thank you for tuning into this episode of Money Not Math. If you found this information valuable, please consider subscribing, leaving a review or comment, and sharing it with a friend or on your social media page. And remember, if you're looking for personalized retirement planning advice, I'm here to help. Until next time, stay informed and make smart decisions. Disclaimer, this content is not legal, tax, or investment advice. You should always consult a qualified professional regarding your personal situation. Thank you for your time and hope you have a great day. Bye.